to the Milliman Hangout. My name is Jeremy Engdahl Johnson. I'm joined today by Zoroast Wadia. Zoroast is the author of our Milliman 100 Pension Funding Index, and he's here to tell us a little bit about the latest in pension funding. How you doing, Zoroast?
Pretty good, Jeremy. Happy to be here.
Yeah, good to have you here. So I understand we just put out some results this morning. What is the latest news in the world of pension funding?
Okay, so yes, our latest May index came out earlier today, and it looks at the funded status for the top 100 pension plans as of April 30th. So in April, the pension funding deficit actually grew by $37 billion, and that was primarily due to the liability increase of $60 billion. On account of discount rates falling 24 basis points. The discount rates actually are below 4% for the first time this year now. It's a pretty low discount rate threshold. On the other side of the balance sheet, the assets had a positive month during April. In fact, April was the strongest month this year so far, with investment returns coming in at about 1.78%. Now, on an annualized basis, that's closer to about 23 to 24% returns. That's much higher than the 7.85% expectation for 2013 as disclosed by the 100 companies in our latest Milliman pension funding study that was released earlier in March. So we had positive news on the asset side. Assets increased by about $23 billion, but because of the $60 billion increase in liabilities, there was a net increase in the funded status deficit of $37 billion.
Okay. Well, I know it's been a strong year on the asset side, and yet we're still trying to work our way through these record low discount rates. It sounds like that continues to be a big part of the story.
Certainly, the discount rates are the main driver behind the liabilities, and they essentially dominate the funded status.
Okay, so where do these latest results put us historically? We've been doing this research for about 13 years. Where do we stand as of the end of last month?
Okay, well, historically, let me see if I can pull up a PowerPoint slide that I have, which summarizes the funded status and or surplus for the past several years. Okay, I'm going to do a screen share right now. Okay, can you see the funded surplus / deficit graph now?
Yeah, I see it. Looks like lots of red ink.
Yeah, well, lately lots of red ink. This graph pretty much shows the funded status history over the past 13 years, which is how long we've been conducting the Milliman 100 pension funding study. There are 4 distinct surplus and or deficit periods. The surpluses are indicated by the blue bars, the deficits by the red bars. Just looking at the more recent or second half of this chart, we see that we last had a surplus during 2007, just before the Great Recession or World Financial Crisis, and then since 2008 we've been stuck in the doldrums of pension funding deficits, and lately we had been going in a positive direction so far this year, but once again, as of the end of April, we have fallen below the $300 billion funded deficit threshold.
Okay, so what's it going to take if we want to climb out of this $300 billion hole?
Well, looking at where discount rates are currently, which is just under 4%, and if assets for the rest of the year return at their expected level of about 7.85%, we probably end the year at about 84% funded status. Now that's still an increase from where we started. At the end of December 2012, we were funded at about a 77% funded ratio. Now, if we were to get interest rate help or cooperation, and so if interest rates were to climb up to about, say, 4.5% by the end of the year, and we were to get stellar asset performance, returns close to 11% or maybe even 12%, then it's possible that we could finish the year with a funded status around 90%. So that's certainly, I would characterize that as a healthy year. But again, those are some big ifs. It depends a lot on how cooperative interest rates can be.
And they haven't been very cooperative lately.
Not really, just more like bouncing back and forth, really. So giving us a bit of hope, but then taking our hopes away with another discount rate decline.
Yeah. Well, while we're on the the topic of projections, I want to hear your NBA Finals pick. Who's it going to be? What's the matchup?
That's an interesting question. Well, I guess I don't want to disappoint New York Knicks fans, but I strongly believe that the Miami Heat are going to win it all again this year, and I would think that they would beat the Memphis Grizzlies.
All right. Bold prediction. We'll see how that holds up next week or next month. Anybody interested in our pension funding study can find it posted at milliman.com/PFI. I invite you to read more about our pension analysis there, and we'll be joining you again in a month with the latest results. So thanks for your time, Zores. Thanks for joining the Hangout.
Thank you, Jeremy. Happy to have participated.
All right. Take care.